and welcome back to DukascopyTv. Joining me in the studio today to discuss a case for diversification is Houmard from private bank Edmond de Rotshchild. Joel, thanks for coming in today.
My pleasure.
Now, with regards to diversification, could you tell me a little bit about it in this context, please?
Diversification is a fairly simple concept, but unfortunately not always well understood and not well implemented. Basically, it's the good old advice, do not put all your eggs in one basket. In financial terms, it's just trying to reduce the risk, the systematic risk, as much as possible for a given expected return.
Okay, interesting. So I would assume that most portfolios are well managed then?
Unfortunately not. Recent studies showed that approximately 70% of private investor portfolios are under-diversified. So that's really our role to say to people, hey, diversify your portfolio, it's very key, especially in this market environment.
So what are the main reasons for under-diversification then?
I would say there are three main reasons for under-diversification. The first one is linked to behavioral finance. When it comes to manage money, usually emotions or stereotypes tend to take the lead. I could spend a few words on optimism or overconfidence. Basically, it's when the investor tend to ignore the fact that risk and return is correlated. So it leads to have portfolios that are very concentrated on one or two positions. I can also say a few words on familiarity. Basically, it's when we only invest in what we know. It's a very short example is the bank employee that is earning a salary from his bank, and he's investing money in the same bank, and probably will also invest into competitors just because he knows the industry quite well. So familiarity also tends to have and lead to concentrated portfolio. The second reason is dispersion. A good example for dispersion is geographical diversification. It gives the impression of diversification, but basically if you invest into a company that is active on the global market, basically either it comes from Switzerland, Germany, or the US, it will be influenced by the same risk factors. So it's very key to look at this risk factor before investing. It's by far better to invest into different sectors like financials, utilities, healthcare, or mining. But basically, how many companies you really know in mining? So it leads us to the last reason. It's the lack of knowledge. Basically, because we like to invest only in what we know, our portfolio will never be better than the set of knowledge we have. So it's the reason why I strongly advise people when it comes to manage the money to take the advice of a wealth manager. But it's also very important to challenge your wealth manager, because what I said for individuals is also true for wealth manager. Your portfolio will never be better than your investment manager knowledge.
But if you have a strong inkling of knowing what to buy, do you really need to be diversified?
It may sound obvious, but like a very good of mine like to say, when it's obvious, it's obviously wrong. As an economist or a wealth manager, we're not a fortune teller. Unfortunately, we do not have any crystal ball. What we know is the present and the past, and what is true today may be not true tomorrow. The very famous writer and trader, Mr. Taleb, explained the role of black swan in the economy. Basically, a black swan is an unpredictable event that can have a huge consequence, either positively or negatively. The role of diversification is really to protect your portfolio from this kind of negative event. I could speak of September 11, 2001 as a black swan, or the Madoff fraud, or even the Lehman Brothers bankruptcy. Were they predictable? I don't think so.
But in 2008, for example, during the crisis, the vast majority of portfolios were negatively hit, even those which were acceptably managed. Is this the case? What do you think about this?
It depends on what we think when we think of acceptably well diversified. The good old portfolio that combined bond, cash and stocks is not what I would consider as adequately diversified. When you manage a portfolio, you also have to invest into real estate, into hedge funds, into commodities. So it really brings you a better standard of diversification. If you take an investor who were invested during 2008 and 2009, basically with an efficient portfolio, with an efficient balanced portfolio, he was flat during the whole period. So by investing into different asset classes, you can really bring your portfolio to a better standard. And in 2008, asset classes like gold, like Swiss real estate, like certain non-directional hedge funds or very high quality bonds made quite well. So it must represent approximately 40 to 60% of your whole portfolio.
Okay, so quite a large or quite a broad spectrum then. Finally, any last minute advice for people looking to diversify their portfolio, Joel?
Basically would be to not confuse between human capital and financial capital. Human capital is the present value of your future earnings, and the financial capital is your investable assets. So try to not be correlated with human capital and financial capital. So basically do not invest in the company or in the industry you're working in. It's probably easier said than done. So
a lot of valuable advice there and a lot of good tips. Thank you very much, Joel, for your insights today.
My pleasure.
Thank you. Now, that's all we have time for at the moment, but the TV team will continue to bring you updates throughout the day, so please do stay tuned. Goodbye for now.